And this is why we think we're early innings of a secular dollar bear market. And I think the Trump administration will welcome that. They're not going to fight that. But at the end of the day, it's not going to be great from the perspective of the cost of capital that we're going to have to pay in our stock and bond markets if you lose that broad tailwind of currency support. Folks in the administration, if you're listening to me talk, you got to start with the capital account and not focus on the current account. The capital account is what matters, because ultimately, if the rest of the world doesn't like your policies, they will sell dollars, sell stocks, and sell U.S. bonds, just like we saw on multiple occasions throughout April. And that is how you end empires, period.
Our next guest has correctly called for a market downturn in 2025. Last time he was on the show, Darius Dale called for a potential market correction. He said the conditions are right and are in place for a market crash in 2025. Since then, since he was on the show in January, the S&P's down about 10% year to date. The NASDAQ was down about 20% at its trough. So what's next? And should we be allocating more to defensive allocations, or is this the bottom? Darius Dale from 42 Macro joins us once more. Welcome back, Darius. Good to see you.
It's great to see you, David. Thanks for having me back, and I appreciate the warm introduction there. We're doing a good job for our clients this year.
Yeah, good call. Back in January, we had you on. Middle of January, back then you had 50% in cash. Good call. So are you changing your allocation now that we've had this correction that you've been kind of warning us about?
Yeah, great question. So, as we talked last time I was on the show, we are purely systematic investors here at 42 Macro. All of our recommendations on the asset allocation and portfolio construction side of things come from the form of our, institutional grade risk management overlays, KISS being the process that we talked about last time for retail investors, and Dr. Mo being the more complicated, more sophisticated process for helping institutional investors pick factors long and short. And so when it comes to changing those allocations, the only thing that's going to guide those allocation changes is if we go into a different market regime, or if the individual exposures within those overlays change from the perspective of their independent volatility adjusted momentum signals. In terms of where we are today, we still have a pretty healthy degree of cash. We're pretty uninvested as it relates to the equity market. We are overly allocated to the gold market and have been, and that's created a lot of positive performance and alpha for us and our clients this year. And then we have a small kind of half exposure to Bitcoin relative to our maximum allocation. So most of the risk that we're taking currently for our clients, at least the risk that we want our clients to be taking, is concentrated in the gold and Bitcoin markets right now, because those allocations, those signals are actually better than the equity signal right now. I can see a scenario where the equity signal continues to improve and eventually take our KISS allocations and our Dr. Mo allocations higher, but that's not our base case scenario. Our base case scenario is that we are in what we've been saying is a W-shaped market in a U-shaped economy. And what I mean by that is that if you think about the shape of a W, we're sort of on the inside left of the W, and we're expecting over the next 1 to 2 quarters that the markets will eventually have to sell off again and price in the inside right of the W to account for the fact that the economy, we're still very early on in this U-shaped economy thesis. And if that is true, then I would expect our KISS allocation to equities and our broader equity signaling to remain generally uninvested or generally, kind of defensive until we get past the second part of that, the inside right of that W. To the inside right of the W concludes, it's very likely that we remain fairly defensive if our fundamental research is correct.
Are we currently on the inside left of the W-shaped recovery or market action, meaning we're about to see some sort of bounce?
Yeah, well, we are in a bounce, right? I think we've retraced about half the drawdown from the February 19th high in stocks. And that makes a lot of sense, right? If you go back to April 9th, when President Trump, in our opinion, we think the bond market broke President Trump and robbed him of the fortitude that's required to facilitate a very expeditious transition, the transition that you and I talked about back in January, from paradigm A to paradigm B. If anything, it looks like now we are going to paradigm C, which is a combination of paradigm A with a little bit of supply side economics sprinkled on top. And in my opinion, we can talk about how that's a disappointing outcome from the perspective of Main Street, the folks who, voted the Trump administration in. But from an investment standpoint, in our opinion, the most important signal that we've gotten as investors in 2025 is the fact that the bond market broke President Trump and robbed him of that resolve. And as a function of that, it's our expectation that the trade negotiations are going to generally go well, with the exception of the trade negotiations against China. It's very clear that the Chinese are digging in, and they should. They're going to win the capital war, which ultimately means they're going to win the trade war. And so ultimately, as a function of the other trade negotiations likely going well, it makes a lot of sense that the markets have bounced and have latched on to the fact that the bond market broke President Trump back on April 9th. Eventually, however, that stuff will run out as it relates to its ability to propel markets higher, in our opinion, because we still do have a growth slowdown ahead of us that, in our opinion, is not appropriately discounted at current valuations or current credit spreads.
If the economy hasn't fully factored in the impact of the tariffs, and let's assume that the government knows that, there's some game theory involved, right? Do you think the government and or the Fed will preempt any slowdown by either enacting fiscal and or monetary stimulus?
Yeah, that's a great question. To me, that's the big question, right? Is the timing, right? In our opinion, the reason we think we have a W-shaped market as opposed to a V-shaped market, and we're there's no real left tail risk in the markets anymore. The reason we see that there is still left tail risk in the markets is because once the markets start to realize the slowdown in the economy and the hard data, and you start to see consensus sales, GDP earnings expectations really start to ratchet lower, the markets are going to start demanding policy support. They're going to look at the Fed and say, give us rate cuts, give us QE. They're going to look at the fiscal authority and say, give us more tax cuts, give us more fiscal expansion from a spending perspective. The timing by which we receive monetary and fiscal support, in our opinion, there's a timing mismatch between when the growth slowdown is likely to be realized. The Fed's in a box because of inflation. We know they're going to be late. They've already signaled they're going to be late. By definition, they have to be late unless there's a significant degradation in the labor market. And any significant degradation in the labor market, which pulls for the timing of Fed easing, will also increase the implied recession probability among the minds of investor consensus, right? So it's almost like, I'm not even sure you really truly want Fed easing, because the path to getting Fed easing is going to cause a lot of pain and problems in asset markets from the perspective of increasing the probability associated with a recession. So that kind of puts the Fed on ice for a while. As it relates to the fiscal dynamics, we continue to get signals out of DC that suggest that the fiscal policy support will be delayed. Scott Bessent, the Treasury Secretary, has outlined July 4th as a potential target date for ratifying, for pushing the reconciliation bill through Congress. Senator John Thune is outlined sometime in August as what do you call it? He said sometime in August would be essentially a best case type scenario, right? You still have to corral a decent amount of voices across both the House and Senate in terms of getting everyone on board for the various provisions of the reconciliation process. So it's our belief that at the earliest, we're going to see the tax relief come in, sometime in mid to late August. At the earliest, it could drag out well into Q4 of 2025, just as a function of the battle between fiscal hawks in Congress as it relates to the Freedom Caucus and the Sawtooth Republicans, and what they're going to demand as a function of this process. And then obviously you have the president's priority list as well: no tax on tips, no tax on overtime pay, no tax on Social Security. What's it called? The immediate expensing of factories and the deductibility of domestically produced auto loans, auto loan service. There's all this stuff that needs to get crammed into a reconciliation package. And in our opinion, that's going to take months and months and months to get it done. And in our opinion, we would just be watching the economy slow in that months and months of time. And in my opinion, that will cause, left tail risk for the market. There's a view out there that may have already been discounted. And if we're wrong on that fundamental research view, then it will have already been discounted in our case. And Dr. Mo signals will kind of just chase the market higher on a lag. But again, that's not our modal outcome from a fundamental standpoint.
Let me just clarify what you mean by market slowdown. Do you mean a recession? By the way, here's an article from CBS. In a research note on Monday, economists at Goldman Sachs put the odds of the economy entering a recession within the 12 next 12 months at 45%, up from 35% in its previous forecast. So they've upped the probability of a recession this year. Now, when you say slowdown, do you mean just positive growth except slower, or do you mean actually negative growth, which is what a recession is?
Yeah, that's a great question. No, so I would make a distinction. In fact, you go back to what we've been calling for is we see the economy heading into a technical recession. A technical recession is just a mere collection of negative quarters where you're having negative growth. It could be modestly negative, could be meaningfully negative. If it's meaningfully negative, it's probably going to wind up snowballing into a credit cycle. That's our base case scenario. An actual recession is different from that. That's the NBER style recession where you see a broad-based decline in consumption, production, income, and investment across the economy. You wind up with a credit default cycle. It snowballs, and ultimately you need a tremendous amount of monetary and fiscal support to kind of hit the e-brakes on that entire process. That's not our base case scenario. Again, we do see, kind of the light at the end of the tunnel from the perspective of tax cuts, deregulation, positively impacting the economy. Eventually, the Fed will be on board, especially if the market scenario doesn't gets significantly worse, and they can start to envision a world where the labor market is much worse than it is today. But again, the Fed, in our opinion, is going to be the most lagging policy responder here in this process. So, technical recession, you probably just have some left tail risk in markets. I think at worst, we retest the lows in stocks. I don't think we're going to retest the lows in crypto. I don't think we're going to break down into a bear market in gold. In our opinion, if you had an actual recession, you're going to blow right through the lows that we saw in early April, right? In our opinion, you're talking about down 30 to 40% in S&P terms if we actually had an actual recession based on the precondition of what our positioning model was signaling, earlier in the year at the all-time high.
Can you just explain again what the difference is between a technical recession and a full-blown recession?
Yeah, exactly. So a technial recession is just multiple quarters of negative growth. Could be modestly negative, could be meaningfully negative. Who knows? It's just multiple quarters of negative growth. Where an actual recession is multiple quarters of negative growth that actually snowball from the perspective of a rising unemployment rate, a rising credit default cycle, and ultimately significantly worse asset market performance that ultimately needs a significant degree of fiscal monetary support to kind of stop that process. And that's not our base case scenario.
And I think the NBER, the National Bureau of Economic Research, actually doesn't even define a recession as just technically 2 quarters of negative growth.
They don't.
They have, like you said, a series of, I believe, 7 other indicators that also have to be flashing red concurrently for a recession to be categorized.
Again, you need to see a broad-based decline of consumption, production, income, and investment across the economy. You're also, if you saw that, you will see the unemployment rate rise meaningfully. You will see credit defaults and credit charge-offs rise meaningfully as well.
Why won't we see that, though? Why won't the economy get to that point?
Yeah, I love it. That's one of my favorite questions, and I think it's a really important question to explain with the chart. Right? If you look at our analysis, that kind of it helps investors understand where we are in the broader credit cycle. If you look at the preconditions of the economy from a credit cycle standpoint, it's highly unlikely that 2 quarters or multiple quarters, I'm not even pretending like I know exactly how many quarters, but just negative growth in and of itself is unlikely to snowball from a credit cycle perspective. And you kind of need it to snowball in order to have a broad-based decline in consumption, income, production, and investment. And so we just don't have the kind of imbalances and excesses in the private sector that in this particular business cycle that suggest, a significant slowdown in growth is going to snowball. We don't think it's going to snowball. And so let me unpack the various indicators in this chart that can kind of explain why we have that belief. The blue bar or the blue line in this top panel shows the private non-financial sector debt to GDP ratio that at 145% has been declining this entire business cycle. What that ultimately means is that the economy has grown faster than credit growth throughout this business cycle. And the reason that's meaningful is because for 2 reasons. One, statistically, we have a negative credit gap. And what that is a 5-year Z-score of the private non-financial sector debt to GDP ratio. And the reason, economists look at the credit gap is because historically speaking, when you have a positive credit gap that's kind of in excess of 1.5 to 2, which is what you typically see heading into recession, if you're talking about a significant, you're talking about a really fast growth rate of credit. And anytime you grow credit really fast from an economic standpoint, what ultimately happens is you have capital misallocation, which is allocating credit to low productivity sectors of the economy, and adverse selection, which is allocating credit to borrowers that probably aren't going to pay you back. When you grow credit really fast at the economic stand from a macroeconomic standpoint, you're going to wind up with capital misallocation and adverse selection. And so any significant slowdown in growth is going to, cause a high degree of non-performing performance with respect to getting paid back from a lending standpoint. So we don't have that precondition in this economy. It's very unlikely that we have significant amounts of capital misallocation, adverse selection with a credit gap of minus 1.6. You would have to see something greater than positive 1.6 to even anticipate something like that. The second thing I'll say is, if you look at our debts, private sector debt, private non-financial sector debt service ratio, it's been rising over the past couple of years, but it's still at this lowly 15% type level. Historically, if you go back to the last two business cycles where we actually have this data, you're talking about an 18 to kind of 20 range, 18, 19 range in terms of the private non-financial sector debt service ratio in terms of getting us into recession. So we got a lot of hay to bail from the perspective of debt service costs being an issue for borrowers and enough to cause them to significantly pull back on their consumption, income, production, and investment across the entire economy. Two other things I'd say are a little bit less relevant, but they are relevant. If you look at bank share of private non-financial sector debt, it's down at 30%. So what that ultimately means is the capital markets, allocate roughly 70% of the credit here in the U.S. economy. And obviously we've had a crash, already, and we're already in what we consider to be a global debt refinancing air pocket. However, just the mere fact that capital markets are reasonably open tells me that, we can continue to grow, that the credit cycle will ultimately find itself to the extent asset valuations will, get to levels that cause investors to feel comfortable taking risk. And so that insulates us quite a bit as well, as opposed to banks who have to raise, cash for charge-offs and things of that nature. It's a bit different than bank credit. And then finally, I'll say is if you look at the amount of cash on private sector balance sheets is roughly equivalent to the amount of total loans and leases on commercial bank balance sheets. And the reason that's meaningful is that, we have this historically elevated policy rate relatively to the last business cycle of 4.5%. And so, yes, for some borrowers in the economy, that is an elevated policy rate and it is tightening fiscal financial conditions for them. However, at the aggregate level, from a macroeconomic standpoint, the amount of cash we are receiving from owning short duration assets is roughly equivalent to the amount of debt service costs we'd be paying for borrowing in short duration assets. And so that's positive as well. And it is really relatively new from the perspective of this business cycle. Recall that it was kind of in the 50-ish% range prior to COVID. So these are all very favorable credit cycle dynamics. If you're ever going to have an economy get hit with a negative supply shock like tariffs, this is the kind of credit cycle dynamics you want to see ahead of that to give yourself confidence that it won't snowball into an actual recession. If
the economy does slow down, though, are you not concerned about credit defaults rising, thus making this chart look worse than it does now?
Yes, but the key takeaway is that credit defaults, based on what the chart looks like now, it's very unlikely that we see a significant rise in credit defaults. That's the point. Okay. The lack of capital misallocation and adverse selection tells you that, although if we have a significant slowdown in growth, you're probably going to see some modest uptick in credit defaults and charge-offs. You're just not going to see a big enough uptick in credit defaults and charge-offs that would be associated with an actual recession.
Can you go to maybe a chart that highlights your asset allocation currently, and just going back to the KISS model? I think, is it fair to assume then, Darius, that investors can probably use some sort of model that would suggest defensive, but not outright shorting the markets for now?
Yeah, well, look, if you're a retail investor, I don't think any retail investor has any business shorting assets. Quite frankly, why? Why are you introducing four-dimensional, market risk into your portfolio if you're not being paid to do that, right? Hedge fund managers, this is a public service announcement. They're taking my investor hat off on and putting my, public servant hat.
Okay, all right, thanks for that.
Yeah, look, we have clients all around the world who get paid millions of dollars to take four-dimensional risk in their portfolio on behalf of other investors. If you're a regular person sitting at home, why are you inserting that amount of stress?
Because it's so much fun, Darius.
Oh my God. Go find a different hobby. This is the kind of hobby that can ruin your family's financial future.
Fine.
You have fun doing this. Just do it and execute it properly take it seriously like the sharks on the other side of your trade. You know who's taking it seriously? Me and our thousands of clients. So we're happily take your money if you don't want to take it very seriously and you want to turn this into a game. This is not a game. This is not a game. Investing is not a game. You want to go have fun, go watch sports. Go take your kids to the science fair. That's fun.
Yeah.
Investor hat back on.
Fair enough. All right. So let's not short the markets if you're not Darius Dale and your clients. But okay.
If you're a retail investor, don't waste time shorting because you're not going to be good at it. Most retail investors suck at short. Most retail investors are not going to be very good at investing to begin with. So that's why services like mine exist, because we help them elevate the outcomes that they experience in their portfolio. And the number one thing I tell retail investors is stop making investing harder than it has to be. Your job as a retail investor is to maximize upside capture in a bull market and minimize downside capture in a bear market.
Okay, so
it's very easy to do that by just being long when you're supposed to be long and out of the market and in cash when you're supposed to not be in the market. That's
an interesting statement. What if I were a novice trader or an investor and I say to you, hey, Darius, I've listened to your interview or perhaps some other interviews, and I'm convinced that maybe there's going to be a market downturn at some point. We don't know when, but I'm just predicting a direction here. I'm a novice investor. I'm predicting the market to go down just as I predicted the market to go up at some point, right? You're just guessing directions here. So let's say I have conviction. Well, what's wrong with buying, let's say, put options on a stock? Well, let's say not outright shorting a stock, but let's say, I don't know, buying a inverse VIX ETF, not inverse S&P ETF or a VIX ETF, for example.
There's nothing wrong. I'm not saying there's anything wrong. I'm saying it's ill-advised. It is ill-advised. It's easier to do nothing and sit in cash until it's time to buy the dip. That's what I'm saying is I'm reducing the amount of opportunities you have to make a big mistake and ruin your family's financial future.
But fundamentally, how is that different than, let's say, going long the S&P versus buying an inverse ETF? Like, you know what I mean? Like, it's just
because you're introducing multiple dimensions of portfolio risk management.
I see.
When you're short, when you're long, your longs can go up or down. That's it. That's two-dimensional risk management. And so it's very easy to focus on the left tail and try to minimize left tail risk. When you are long and short, your shorts can go up or down. Now you have four dimensions of risk. You've squared the amount of risk you need to manage. And ultimately, you now have all kinds of signals that you need to respond to on your portfolio. And again, I'm not trying to hijack the conversation about the public service announcement, but this stuff is really important. You don't have to pretend like you're a hedge fund manager for free, by the way, in order to retire on time and comfortably as a retail investor, which in my opinion should be every retail investor's goal. Now, if you want to take a little small pocket of your portfolio and say, this is my trading portfolio and I want to play around with this, fine, do that. But don't do this with your entire retirement account. That your family's financial future matters too much for you to pretend to be a hedge fund manager for free. Again, our hedge fund manager clients get paid millions of dollars per annum to do this because it's hard and most of them aren't even great at it. So just be aware of that as an investor. You're adding a tremendous amount of stress and unnecessary risk to your investment process when you decide you want to pretend to be a hedge fund manager. Don't do it.
Fair enough. So let's take a look at your allocation here, your slide. No shorting involved here. Walk us through what these colors mean and kind of the logic behind your allocation currently.
Yeah, absolutely. And I think we did a pretty big deep dive on KISS the last time we were on. So I'm not going to spend too much time going through the actual
process. People can check out my last interview with Darius, by the way, link down below. But yes,
exactly. So in terms of where we are currently, the light blue is our liquidity, so that's cash. So we're currently at 65% cash. We're at 0% of our maximum exposure of 60% in the equities market, and have been since March 5th. We're at 100% of our maximum exposure of 30% in gold. Recall that we pivoted to gold. We pivoted completely this system, which is a completely systematic system that does not factor in anything I say fundamentally. It's all based on our quantitative overlays. We pivoted this system completely out of the bond market and replaced it with gold back in September. And I want to say gold's up 20 to 25% since then. So that was a great call. And then finally, we're at 50% of our maximum exposure of 10% in Bitcoin. And the reason gold is, gold's currently 100% of its maximum exposure of 30. Bitcoin's currently at 50% of its maximum exposure of 10, whereas stocks are currently 0% of their maximum exposure of 60. The reason that gold and Bitcoin look a lot better than the equity and than the equity exposure is because the equity signal, the volatility, just a momentum signal for the equity market remains bearish. whereas it is, neutral for Bitcoin. Actually, no, it's bullish for Bitcoin currently, and it's bullish for gold currently. Okay. So there's a huge, by the way, this is a big topic, by the way, David. Bitcoin is diverging from the stock market.
Yes, it is.
Meaningfully. If you look at the trailing 6-month beta of Bitcoin to the S&P 500, it is now 1. It used to be 2 to 3. Think about that. We just survived a crash where the Bitcoin's beta was 1 to the S&P 500. This is a significant seismic shift in how I think institutional investors will allocate towards this asset class going forward. And we're going to continue to see inflows into crypto, or not crypto, but inflows into Bitcoin specifically, because it is developing in real time defensive properties, much like gold has.
Are you ready to meet the biggest minds in Bitcoin face to face? Well, this summer, the crypto capital of the world isn't Silicon Valley or New York or even Miami. It's Las Vegas, introducing Bitcoin Vegas, the ultimate Bitcoin event of 2025. And this is not your average conference. Join real conversations with people shaping the future of money. Thought leaders like Michael Saylor, Lynn Alden, Ross Ulbricht, Winklevoss twins, David Sachs, and many, many more. Whether you're a hodler, builder, or just Bitcoin curious, BTC Vegas is where ideas ignite, partnerships form, and conviction grows in the space. Tickets are going fast, so lock in your spot today using my link down below or scan the QR code here. You'll get a 10% discount. Get it before tickets are sold out completely. We'll see you in Vegas. I wonder, though, just to play devil's advocate, I wonder how much of Bitcoin's low correlation to stocks during that big decline in early April was simply due to the DXY collapsing. And so Bitcoin being a dollar-denominated asset, it just went down because of arithmetic. Sorry, went up because, the dollar's down.
Stocks are priced in dollars too, by the way. So, that same dynamic is consistent across things. What I would say is,
fair enough.
What I would say is part of the reason Bitcoin's becoming a defensive asset is because it's attracting capital in the middle of a market, a risk-off market regime. And the reason it's attracting capital is what you're saying, David, is because it's, inversely correlated. It's an anti-dollar trade. It's Bitcoin got positive benefit. It was the beneficiary of positive flows into its asset class at the expense of treasury bonds, U.S. stocks, and other U.S. dollar denominated assets or U.S. economy exposed assets, because of the fact that we're seeing this big capital outflow situation develop with respect to the U.S. Now, I don't think it's snowballing like it was early in April. We've kind of put a plug on that for now because, again, we think the bond market broke President Trump and is a desire to facilitate this big expeditious transition, because ultimately trying to bully the world into a new paradigm when you're sort of at the on the hook for global capital to the tune of a $24 trillion net international investment deficit. I think he got the message. The bond market certainly got the message, and in our opinion, the fact that he's been backtracking from a policy perspective ever since then tells me that he got the message. And so that's a long-winded way of saying I think this was the perfect conditions from a market cycle perspective for Bitcoin to kind of wake up and start to experience some of the defensive properties that Satoshi Nakamoto and other Bitcoin proponents have been, sort of espousing for many years. This was, in my opinion, the first time we actually saw it happen in real time. And so this is really noteworthy, in my opinion.
Yeah, so let's talk about this capital outflow that the markets witnessed in early April. Dollar going down while yields went up, not a common occurrence. What was your reaction to that phenomenon?
Yeah, that was the signal, in my opinion. And this is the stuff of emerging market crises. I did a big presentation on emerging market crises, how they work, how they develop back in 2013, right before the taper tantrum. And so that was one of the pieces earlier in my career that kind of, put me on the map in the minds of a lot of institutional investors, among others. But that, so I've had a lot of background and a lot of training in terms of understanding these sort of capital account balance of payments dynamics. And, when you see currency down, bond market down, central bank being hawkish to protect the bond market, these are the types of dynamics that have historically only happened in emerging markets, right? This is that tells you that, there's a real capital flight story here that I think most investors I don't know if I think they got it. I think it's pretty clear that people understood that the bond market blew up and this was a capital outflow story based on the dollar's decline. But what I don't think people understand is how permanent and ever present this risk is as a function of the precondition, but also as a function of any potential policy gaps. So let me start and talk about the precondition, then we'll move on to the policy gaps, right? On the precondition side of things, the U.S. has a net international investment deficit totaling $24 trillion. That's more than 2/3 of its GDP. And by the way, this $24 trillion has more than doubled in the last 5 years, right? This is a time series that goes back to the mid 1970s, and it doubled in the last 5 years, right? So that, in my opinion, I think that tells you how much capital has really accelerated into the U.S. economy in the last half decade as a function of chasing this U.S. exceptionalism theme, this U.S. exceptionalism narrative. If you wanted to compare our net international investment deficit to GDP ratio, it's minus 67%. So it's a 67% deficit. We were at just shy of 15% in terms of our net international investment deficit back in 2000. At the height of our that tech bubble. Now we're in this tech bubble with a essentially 5 times larger net international investment deficit position, or not quite 5 times, but 4.5 times larger. I mean, so that's pretty significant. If you want to look at it as a share of global GDP, it's about roughly 20% of global GDP. It was only about half of global GDP back in 2000. So there's a tremendous. There's just I can't stress to the world enough. It's hard to convey this with charts and words. How much of the world's capital we have sucked up in the last, let's call it 5, 10, 15 years, really in the post-crisis era, where the slope of the line really significantly changed. And in my opinion, this is real risky stuff in the context of this chart here, the next 2 charts. And I'll shut up and after I explain these 2 charts, but they're very important to explain. We have a twin deficit totaling minus 11% of GDP, and that comes from our minus 7% deficit to GDP, fiscal balance to GDP ratio, and our minus 4% current account balance to GDP ratio. So we have one of the widest current account deficits in the world. The next closest economy is like UK and Brazil at -3, India at -1, and then you got the rest of the world, these creditor nations at like China, Europe at +3, Japan at +5, Switzerland at +6. We are financing ourselves as if we're the creditor nation. This chart here shows our, the average between our 10-year nominal treasury yield and our equity index earnings yield. And so it's a general proxy for the cost of equity and debt capital in our economy. Mm-hmm. And at 4.17%, we're on par with like Japan and Switzerland, and even lower than Europe and China. These are economies that are current account surplus economies that supply all of the world's capital to capital markets globally. Yeah. Yet we're the ones paying the cost of capital like we're the ones who have all the money. And so to me, there's this real structural misunderstanding of the root cause of U.S. economic exceptionalism. In my opinion, I think the root cause is we're able to persist with the 11% twin deficit featuring a 7% fiscal deficit GDP and a 4% current account deficit GDP. We're allowed to persist with this kind of capital demand and a capitalization at prices that just generally don't make sense relative to the rest of the world. And so to me, of course, we're exceptional economically. Of course. But to me, so that's the risk. The risk is the rest of the world eventually decides to take their capital ball and go home. And in my opinion, this is why ultimately we think the bond market broke President Trump, because he, either through Besson or Stephen Moran or somebody in the administration who's been reading my stuff, finally told him, hey, this is not how the world works through the trade account. The current account's bigger than that. And by the way, the capital account's more important than that.
Yeah. Would you be looking at emerging markets right now as an alternative to the U.S.?
Yeah, I think you have to. When we break into a risk on market regime, like right now, if you look at our Dr. Most signals, the equity markets that have the best signals right now are all international. Right? We have a handful of sectors and factors within the U.S. market that look fine, but broadly speaking, the best signals right now that are emanating from an equity standpoint are international, including emerging markets. And to me, that is a big, that's a big deal. It's a very big deal. One of the biggest deals that are happening right now is the fact that if you look at currency volatility, you've seen a swap, a flip in currency volatility relative to how it historically has worked. Historically, the dollar has been positively correlated with broad currency volatility because the other currencies were the risk asset. Now, the dollar is the risk asset in the currency market and now is inversely correlated to broad currency market volatility. And so to me, that tells you that, we could potentially be on the precipice of a multi-year, pullback in the dollar. Right? If you look at the dollar on a real effective exchange rate basis, we're very overvalued on those terms. The dollar could go down for years. And so I think any investor that has, certainly institutional investors whose job it is to pick factors long and short. I mean, I would be using any dips to be accumulating foreign assets and foreign exposure to the rest of these markets in lieu of U.S. markets, not because I think U.S. markets are permanently doomed or anything of that nature, but it just seems to me that the dollar's probably peaked. Otherwise we wouldn't be getting that vol signal from the currency market that we're currently getting. To me, that's a huge seismic shift in how currency market pricing is working right now. And it's telling you that something's changed materially.
Great. Well, looking ahead then, what is your view for the dollar? Should we be looking at another currency pair that may be more favorable? I mean, the Swiss franc, as an example, went up dramatically during the first week of April. The Canadian dollar, which has been trending down, has also been strengthening. Anything else?
Yeah, 100%. Gold, like exactly what we said back in October. And by the way, our discretionary risk management overlay has been long gold since October of 2023. We just pivoted our KISS system to gold and out of bonds permanently into gold as a function of having more conviction on our fourth turning inspired research views. But to me, the best currency in the world has been and is very likely to continue to be gold, because as everyone says, when you listen to people in institutional finance, kind of push back on these types of research views, we have clients all over the world. Our clients collectively manage over 25 trillions of dollars of AUM. So obviously we were talking to some pretty big, important people. When they push back on these types of views, and they certainly aren't as much anymore, and obviously price has contributed to that lack of pushback that we've seen in recent months. When they push back, and they always go to the same place, which is, the dollar is the reserve currency. There's nowhere to go, so the dollar is going to stay the reserve currency. That's very true, but that doesn't mean it has to stay at 58% of global FX reserves, which is where it is currently. You go back to the mid 90s, it was down at 45% or in the low 40s. Right now, gold's at 21%. It was as high as 77% back in the late 70s. Now, it's not going to go to 77%. We have a paper financialized economy. You need dollars to lubricate global trade and global finance. 60% of international bank lending, 70% of the international bond market. So it's not going to go away. But could the dollar go from 58 to 50 or high 40s? Could go from 21 to 30 or mid 30s in the coming years? Definitely, 100%. I expect it to. And part of the reason we expect it to is because of what we just talked about from a twin deficit standpoint. I think we're running towards the end of the rope in terms of the rest of the world's willingness to turn a blind eye to this precondition. This is a ridiculous precondition to have an 11% twin deficit to GDP ratio. Like, the only time you see anything remotely close to this is when you're deep in recession or deep in a COVID-inspired lockdown. There's nothing like this in the rest relative to the rest of the world, with the exception of Brazil. And guess what Brazil pays on average for its equity and debt capital? 11.36%. We pay 4.17%. They pay 11.36%. And so it's our view that, based on the precondition of this very bloated net international investment deficit to GDP ratio, our bloated twin deficit to GDP ratio, and our general overvaluation of our bond and stock and bond markets, is that the rest of the world after 2025 is going to be looking around for places to go that are not the U.S. economy, period. And that's going to be a multi-year process. And this is why we think we're early innings of a secular dollar bear market. And I think the Trump administration will welcome that. They're not going to fight that. But at the end of the day, it's not going to be great from the perspective of the cost of capital that we're going to have to pay in our stock and bond markets, because that cost of capital is going to go up if you lose that broad tailwind of currency support.
I believe, if correct me if I'm wrong, but I believe the Trump administration is trying to close his current account deficit and he said this multiple times in media, he wants the trade deficit to be reduced vis-a-vis other trading partners, which is part of the reason why he implemented tariffs to begin with. Is this a strategy that has any legs?
It's a dumb strategy, and I don't mean to say that to be disrespectful to our president. I respect him as our president and rooting for him to be very successful. But it's a really, really short-sighted kind of strategy that really, quite frankly, is disrespectful of like grade school level economics.
Okay.
You cannot force a closure of the current account deficit without having capital account deficit ramifications. And so ultimately what that means is if you want to close the current account deficit, you need to produce more and save more from an economic standpoint, period. And the only way to do that is not by bullying your trading partners into producing less.
But if you force other trading partners
you
to
can't
import
force the
more,
rest of the world to do anything. This is the mistake they're making, is that
Sure.
they're forced, they're on one side of the equation, they're begging the world for money to plug an 11% twin deficit hole.
Yeah.
Yet they're also on the other side of things saying, do what I tell you to do.
Yeah.
It is a dumb policy that's not going to work. The only way out of this mess is to take our 7% deficit to GDP ratio much higher, i.e. higher in absolute terms, i.e. narrow the budget deficit so that we save more from an economic standpoint, and it ultimately causes our current account deficit to narrow, back towards something that's a little bit more healthy, like a -1 or -2% ratio, which relative to our creditor economies would still be, pretty vulnerable from the perspective of having dramatic capital outflows. So austerity is the only way out of this mess. It's not by forcing our trading partners into ridiculous trade deals that only favor us, that are not going to be complied with, just like the USMCA was not complied with, just like the Phase 1 China trade deal was not complied with. They're not going to go along with this stuff because they realize that it's our money it's their money that we're borrowing to plug this 11% hole.
I believe at one point in American history, exports were greater than imports. That's no longer the case. In theory, if we were to go back to that, that would solve this problem, right?
Yeah, of course. But I mean, it's not going to be that way for a while. I mean, you got to go back to the 70s to see us have a current account surplus.
Yeah.
Last time current account surplus was in the mid 70s, mid to late 70s. So I mean,
there's no trade policy the Trump administration can enact that could take us back to that time, which is, I believe, what they want. But
yeah, well, again, the appropriate policy to do it is by fiscal austerity that raises our net national savings rate and narrows our current account deficit. That way, you don't piss off our foreign creditors and cause a blow up and exacerbate the geopolitically driven supply-demand imbalance in the treasury market.
Yeah.
Foreigners own 31% of our treasuries at just shy of $9 trillion. Investors, the investor class, people who want units of return for taking risk in their portfolios, now own nearly 60% of the treasury market. Those are two terrifying ratios in the context of making policy blunders. You got to get this right from the side of the administration. So folks in the administration, if you're listening to me talk, you got to start with the capital account and not focus on the current account. The capital account is what matters, because ultimately, if the rest of the world doesn't like your policies, they will sell dollars, sell stocks, and sell U.S. bonds, just like we saw on multiple occasions throughout April. And that is how you end empires, period.
Is that the track that we're on now, you think?
I don't think so, because I think they got the message. I think they got the message from April 9th. That was the track that we were going down prior to April 9th.
Right.
Yeah.
And that's why they pulled a lot of the tariffs off. Okay, well, fiscal austerity, I believe that was kind of the point of DOGE. What's the latest with that? All right. You're laughing. I'm laughing with you, buddy. What's your take here? What's happening?
Doing my best kabuki theater impersonation, because very clearly that's what it turned out to be. I mean, again, I don't want to be too preemptive when I say this, because at the end of the day, we still don't technically know. They're being very coy and very non-committal with respect to the targets and what they've cut and what they intend to cut. And to me, that's a signal. Like, if you were going to go in and cut some things, remember when it was all kabuki theater back in the fall, they were being very committal about the numbers. It was 2 trillion. Then they said, okay, it's 1 trillion. And then they doubled down on multiple occasions that it was 1 trillion. Now it's very unclear that if it's even going to be that. They're talking about right now, they're in the 150 to $200 billion range. If you look at sources like, the BBC, which, may or may not be partisan. I don't pay attention to who's partisan and whatnot, but, some sources are basically saying like they only have about 30% of the savings are actually real savings. And the rest is all kind of, fluff that the Biden administration already, identified as going out the door, or going by the wayside. But that's neither here nor there. My key takeaway is that if they walk DOGE back from $2 trillion with the chainsaw to $1 trillion on Fox News on multiple occasions to now somewhere closer to 150 billion or 200 billion.
Yeah.
I mean, we're talking about a drop in the bucket as it relates to, annual federal expenditures. Right now, if you look at annual federal expenditures, going back to the February peak on federal expenditures, even if you took a full $1 trillion out of that, which they're very clearly not on track to do, you still would have wound up with a federal budget balance to GDP ratio of minus 5%. So you would have had a 5% deficit, fiscal deficit to GDP ratio if DOGE took a full $1 trillion out of federal expenditures and it had no economic impact whatsoever in terms of lowering the tax base, right? Obviously, if you took $1 trillion out of annual federal expenditures, you're probably going to slow the economy enough to slow broader economic activity and tax collection. So you're talking about probably even landing at a 6% deficit to GDP ratio. And so it's our belief that, I don't want to say why they are punting on this DOGE process, but in my opinion, here's what I think is happening. I think President Trump realized on April 9th that, oh man, I'm probably going to be unsuccessful at facilitating this transition as fast as I would like it to be. And because he's on a midterm election type time horizon, whereas the rest of the world's trading partners are on their own time horizons. And so as a function of that, they've completely pivoted to pro-growth, pro-markets, and they're no longer willing to tolerate economic pain, a period of adjustment, detox period, restructuring. They are now saying we are fully on board with this fiscal monetary largesse that we got elected for calling out as a function of Biden's K-shaped economy. Now they're on board with adopting that fiscal monetary largesse. I mean, don't forget, they're talking about $5.8 trillion of debt finance tax cuts coming down the pipe. This is the kind of stuff that, this is why I've been saying for quarters now that both the Republicans and Democrats are pushing us towards a fiscal cliff. And at some point, when the rest of the world wakes up and says, you know what, we have other alternatives to capitalizing, other better alternatives than to capitalize an 11% twin deficit GDP ratio in the US. Why don't we just capitalize our own companies, or, I don't know, buy more gold instead of US Treasury bonds, or, I don't know, buy a little bit of Bitcoin instead of every dollar we got to invest goes to US tech stocks. If the world decides to do that, we're screwed, period. And I'm concerned that by the end of this process, maybe it's this administration or maybe it's the next administration, I don't think we'll survive beyond the next administration with these types of dynamics going on from a capital account standpoint, without it causing significant harm to our way of life here in America.
We've got 2 minutes left. Darius, show us one more slide that's really interesting from this deck.
Show us one more slide that's really interesting from this deck. Ooh, that's a hot question. That's a hot question.
Yeah, you've got a few minutes to present to us one more really cool slide.
Yeah,
that we haven't talked about yet. Yeah.
Yeah. So I want to remind investors, right? Like, and again, I continue to go back and say, I think we're in a W-shaped market and a U-shaped economy. Let me just draw that on the screen here. Like, if this is the economy, that's the U. I think we're probably right here in the U.
Okay.
If this is the market, we're probably right here somewhere in the W. Could it keep going up? Yeah. But I ultimately think we probably need to go back down again from the capital market standpoint, stocks, credit, in order to price in what is going to be the ultimate economic impact of Smoot-Hawley tariffing ourselves. Even if you exclude the reciprocal tariffs that were punted by 90 days and just left the 10% baseline tariffs, the sectoral tariffs that have been announced already, you're talking about taking our average tariff rate to the levels that were consistent with Smoot-Hawley back in the early 30s. That's going to have significant economic impact on top of the fact that we have this historically elevated level of policy uncertainty. We got basically an all-time high type reading on the Baker, Bloom, and Davis Economic Policy Uncertainty Index. That's going to cause folks like you and me who run businesses to, tap on the brakes. Nobody's going full bore ahead. I'm going to do this CapEx or this big hiring plan right now. Everybody's waiting around to see what the taxes are going to be, what the deregulation is going to be, what the tariffs are going to be. We're all waiting. And that collective waiting is why we have that U-shaped economy. All that's going to happen is why we wait. The economic activity is going to continue to grind towards a halt and maybe even wind up in a technical recession, which again, as we started the conversation, is a multiple quarters of negative growth. Doesn't have to be significantly negative, but it is negative. And the key takeaway on all that is that if you look at consensus sales, GDP, and earnings estimates, they do not account for the U. They account the consensus sales, GDP, and earnings estimates reflect a V where Q2 is the bottom. We're saying it's a U where Q3 or Q4 is probably going to be the bottom. And so consensus estimates need to account for that reality, which is why we still think that second part of that W, the inside right of the W, is still ahead of us and not necessarily behind us.
Excellent stuff. Where can we follow 42 Macro, Darius?
I appreciate you, David. Thanks for, as always, giving me an opportunity to help educate people. As you can see, we do phenomenal research and risk management signaling to help our clients navigate markets. But at the end of the day, I still am a human being who cares about people, and I want to make sure that people aren't blowing up their.
Yeah, we appreciate your PSAs. We should come back on and do some more of those.
Yeah, totally. I want to make sure people aren't blowing up their life savings, man, at the end of the day. So come check us out, 42macro.com. That's where you can buy the research and most importantly, get access to the signals. And then if that's over your head or whatever, check us out at I'm on Twitter at Darius Dale 42. I publish my morning note every day. We publish our macro minute every day. We just want to make sure that regular, ordinary people aren't being swindled by people who sound smarter than them. That's it. Period. And some people. Yeah,
you sound a lot smarter than me, but I don't feel like you're swindling me. So that's a good combo.
Yeah, because I'm telling you the truth. I'm red pilling you. It's the Matrix. I'm giving you the red pill.
All right.
I'm giving
follow
our
42 Macro to get the economic red pill of the day. That's what you should do. Check out the link down below. Follow Darius there. Give him some support. Give him some love. Thank you, Darius. Welcome back to the show, and we'll see you next time.
Always a pleasure, David. Thank you very much, brother.
Thank you for watching. Don't forget to like and subscribe.